In 2025, we still have plenty of bankers with their head in the sand. Why would I pay you a premium for a bunch of customers I don't want, technology I can't use, branch locations I don't need? I'll just punch you in the mouth and take your lunch money. It's not just debits and credits and ones and zeros. It's putting a child through college. It's expanding a business. It's hiring new people. The world is changing and they need to be able to adapt.
In this first episode, we're joined by JP Nicols. You were actually given one of the first hammers to go out and break the banks. People must have thought you were slightly crazy. Tell us about that. Hello and welcome to Money Travels, presented by Visa. I'm Rich.
I'm Max. Welcome to the show.
JP, welcome to the show.
Thank you.
So if we kind of rewind back to 2007, I think it was.
I don't want to overstate my role in that. I was a part of a great team.
You built this innovation program in a major US bank. And this is like pre-Fintech. People must have thought you were slightly crazy. Tell us about that.
I worked for a pretty major bank and a very well-performing one. But our CEO said, oh, that's great, but that's actually not good enough, right? The world is starting to move much faster than we are, and we need to keep up with that. And you're right, we didn't say the word fintech back then. The original name of the group that we put together was the Customer Council. And our mission was really just to get to understand our customers a whole lot better, understand what their needs were, the jobs they have to be done. We started to really pay attention to this concept called jobs theory, right? People hire products, they hire banks to do jobs for them. They can't always articulate it very clearly if you ask them, but understanding what are the jobs that customers need to have done. And that's really how it all started. And I think that was a great place to start.
2007 isn't too long ago, but I guess it's an age ago in terms of technology. I want to pick on something you said about a customer council. And this isn't like banks were a new industry in 2007. Why did it take so long for a bank to say, maybe we should start listening to our customers?
Yeah. Well, I think there's a couple of things. You know, in 1993, Clayton Christensen wrote a book called The Innovator's Dilemma.
Yeah.
And the dilemma is that we have real life customers buying our real life products, generating real life revenue. And if we do it right, real life profits. And why should we invest any of our precious limited resources on something new that may or may not pay off at some unknown rate at some unknown date in the future? Yet it is a dilemma because even by 2007, we understood the Kodak story, right? We were about to experience the Netflix story. New technologies do create new capabilities and new expectations from customers. And I think prior to 2007, that's when the industry was going into a global financial crisis and we got very insular and very inward focused. But if you look at what was happening with technology, we had increasing use of broadband and mobile. And the first smartphone, right? The iPhone came out in 2007. So we started to then think about apps. And then this phone was not just a phone, but a powerful computer that we carried around with us every day. Frankly, I was just happy we were thinking about it that early because here in 2025, we still have plenty of bankers, in my experience, with their head in the sand saying that, well, it doesn't matter. We'll always have banks. And I think the reality is Bill Gates has a great quote, we'll always need banking, but we may not necessarily need banks the way that we have thought about them.
I want to pick up on this example about the smartphone and how it's changed the relationship with the customers, basically. And I want to take another example, which is Uber, right? They started with that speed and instantaneity and making sure that, you can have everything in the palm of your hand. Or what were the big customer pain points that you were facing back then? And how has that evolved to where we are now?
I love Uber as an example, too, for a few different reasons. We're so used to ride-sharing services today, we kind of forget what life was like before them. If you were traveling to a distant city, you basically had three choices, right? Get a taxi, rent a car, or you could schedule a limousine. Their credit card terminals were always broken, right? So you had to make sure that you had sufficient cash with you, and then you had to factor in the tip. And even though most big city laws require a taxi driver to take you anywhere that you're going, the reality is many times they wouldn't. And so there were a lot of pain points that were kind of latent and not considered pain points. And I think the same thing was true with banking. Customers kind of put up with a certain level of pain around the way that they interact with their bank that they won't now, because the average customer that can touch a button and get a ride to wherever they want, or touch a button and get groceries delivered, or watch a piece of entertainment that they want, is not going to put up with the idea that, oh, you need to come into the bank branch on Monday morning and talk to us about that. So my view is we want to change before it becomes necessary, so that there's an opportunity to create some sort of new value for the customers before they're looking for alternatives.
I want to go back to 2007. As I said, people looking at you, maybe slightly crazy. You come out of a meeting and you're suddenly the new head of the customer council. Here's your notebook, here's your pen, off you go, JP. Where do you even start? Because I'm guessing some colleagues still have their heads in the sand. How do you start something like that?
We started really just thinking about the customer. One of the things that I remember this is early days of contactless payments, right? There weren't a lot of places that were accepting near field communications, but we started to have that. In fact, it was a Visa card, I will tell you, that had a chip in it, and we cut it out and put it in a little wristband, a little neoprene wristband, and started testing what was that customer experience like to be able to contact us. So maybe you didn't have your wallet with you. It's hard to imagine you'd ever leave without your phone these days, but that was before NFC payments were enabled in phones. And I remember testing at a local gas station where I got gas, and then I went inside and got a soda. And the person working at the store was pretty fascinated that that was the way that I paid. She said no one had ever used that terminal before, but then outspits a foot-long receipt after that kind of, was a non sequitur to that contactless digital experience. That, she prints out this long paper receipt for me that I need to wait and take with me to throw away. We have seen a lot of institutions that start with, let's start wearing hoodies and sneakers to work. And that's not the right place to start, because it's not about dreaming up new ideas. It's about understanding the jobs that the customers have to do. I am a big believer in quick wins. And so doing something that is minor, that, people can get behind rather than swinging for the fences, to use a baseball analogy. It's a good idea to start kind of incrementally. And yes, there were plenty of people who resisted to that.
I want to fast forward and 2025. What do you think are the key levers that the banks have to innovate and respond to those needs? In this show, we talk about money movement, so we go beyond the payments. We also include peer-to-peer transfer, NGOs and government, domestic or cross-border. I'd love you to unfold that for us, to open that box and tell us what are the needs today and how the banks can actually help the end customers to have a better experience.
I think we're still in the very early stages of the transformation of the industry. We have spent a lot of time thinking about the actual technology and the way things happen in the back office, and we're actually quite good at that as an industry. Trillions of dollars are moving globally all the time, and it doesn't get lost. We're really good at that part. We like to think about a concept we call the edge of money. Banks are very, very good at being at the center of money. Debits and credits and zeros and ones, right? We get it. We're very good at that. And that's why there's still a high level of trust around this industry, despite, all the things that we do to get in our own way. But at the edge of the money, or, maybe think about it as the opposite end of the money, where it's close to the customer, it really means something to them. It's not just debits and credits and ones and zeros. It's, putting a child through college. It's expanding the home for a growing family. It's expanding a business. It's hiring new people. And so the more that we can understand the context around that, is the more opportunity we have to put some value around that. When we look at what's happening in that space today, the non-banks are leading the way. There's been a lot of talk lately about somebody like Square, right? In 2009 or 10, if we were talking about Square, we would only have one thing to talk about, a little Square dongle that plugs into the headphone jack of your new smartphone. And today, they've got a 9% market share in small business, and that's small, but this is a massively fragmented industry. They have taken their capabilities and recombined them in lots of different ways to be highly relevant for different segments. So it's not just bars and restaurants and food trucks where they started, right? They have solutions for law firms and manufacturing companies and so on. And so I think it's understanding that the context, and again, it's about those jobs to be done. I think about the early 1990s when we first started to digitize transactions. The banks really just thought, oh, this is great cost savings opportunity. Sign up for e-statements, right? Because we won't have to print these out on paper, put them in envelopes and mail them out. But what was happening is that technology was a trigger that allowed new capabilities. So there were jobs to be done around that. And the Mint.coms and the Quickens and the Yodleys of the world discovered that before the banks. And when we talk about the revolution of fintech and the revolution of money movement, I think that was a really important step because that was the digitization. That led to the digitization of the customer experience. So we started to add more context in the reporting. So somebody would now be able to put a little geotag map on there. Oh, you spent this at CVS on 67th Street, whatever it might be. That in turn led to the rise of the first neobanks. And, as you know, the first neobanks were really built on prepaid payment rails. And so that really led to that kind of revolution. And, now we think about open banking and the idea that, most banks aren't inventing everything from whole cloth, right? They're partnering with others. So I think that's a huge theme going forward is being really good at partnering with others because you're not going to think of everything on your own and you're not going to be able to build everything on your own.
I have a question on, especially in your current capacity and how you talk to kind of community and mid-sized banks. Why should banks come out of the center of money? What's driving them? And they're quite safe, and they're the deposits and loan business makes them some good money. So what's the compelling reason for them to ultimately take a bit of a risk in their business model and step into the unknown?
When I started in this industry in the late 1980s, we had over 13,000 banks in the U.S. Today, we have less than 4,500. So it really is an existential reality to be able to stay current and be able to meet the needs of your customers. But when you talk about risk, banks are very, very good at managing certain risks, the risks that they have identified and have good systems built up for. And we think about things like credit risk, liquidity risk, compliance risk. We believe that there's a set of risks that are kind of underappreciated and overlooked. One is the attrition risk of your own customers. The average age of a traditional bank customer is fairly old and getting older. We're seeing a fairly hard time for banks to really build multi-generational relationships or meaningful ones anyway. The flip side of that coin is disruption risk. So the digital arms race fueled by the largest banks is part of it. But the death of 1,000 cuts from all of these fintechs now who are very, very focused on very specific things to be done and very specific sources of value for customers that makes it really hard. And I think internally, the two biggest risks are also kind of flip sides of the same coin. And the first is the fragility of that traditional business model. In the US and most of the globe, 90 to 95% of banks' income comes from spread income, the difference between what they have to pay out for deposits and what they can earn on loans. There are massive pressures on both sides of that equation, and there are only a few levers that they're able to pull to change that. And so by partnering and adding new opportunities and new sources of value, you can kind of reduce the impact of those pressures. But that fragility of just, hey, we're a bank, so we gather deposits and make loans, I think that will always be true. I will say it's necessary, but probably insufficient as we go on.
I'm sure you have the question all the time, but the very important two letters of the moment are AI.
Yeah.
And I'm really keen to hear your perspective around how AI will impact, change money movement and the customer experience, or not at all, maybe.
I'll quote Bill Gates once again. He has another great phrase that says, we tend to overestimate the impact of new technology over the course of 2 years and underestimate the impact over 10. So I think 10 years from now, we're going to look back and really understand much more deeply the impact of artificial intelligence. I think to date, mostly what we have seen is banks applying artificial intelligence on improving operations. So a lot of great use cases around fraud and risk management. And AI can be really useful when you have large pools of data like that and pattern recognition. If we just ask customers directly what they want, we don't really get a lot of insightful information. So being able to leverage AI to try to pull out maybe some latent signals, I think can be really important. But I'd like to see AI applied a little bit more at the customer experience level and in a good way, not just replacing labor, but if we can really help, suggest next best product or a way to save or reduce fees, I think those are some really good use cases. And I think we'll see a lot more over the coming years.
We've made it this far on the show without actually asking about your current focus at Alloy Labs. It's been great hearing kind of where you've come from, the work you set out to do. Talk a little bit about Alloy and kind of what you do, and if you would, like, what drove you to set it up?
Well, when I left the banking world in 2012, I really was interested in that intersection of traditional financial services and fintech. And one of my early insights was that the minority of people that really are not happy with complacency and really want to try new things, they need a club to belong to because they're surrounded by the business prevention department. And so I started something in 2013 called the Bank Innovators Council. And it was just a way to bring together people who were starting to think about innovation, talk about what are some ideas, how do you get these things done inside the bank, how do you influence others? And I met my co-founder, Jason Hendricks, actually at a Fintech show. And we started kind of talking about the difficulties of getting things done inside the bank. And we started talking to banks about what would have to be true for us to be able to work together, to be able to share the costs, share the risks, and maybe most importantly, share the learnings. One of my other favorite sayings is that bankers always want to be first in line to go fifth, right? Nobody wanted to go first, so everybody wanted to know, well, who else is in? But by the time we started to take final commitments, we ended up with 12 founding banks in 2018. Today, we have just short of 100 banks around the country. If we were combined into one single entity, we would be a top 9 bank, nearly $500 billion of assets. So most of them are between 1 and 50 billion, a few a little smaller, a few a little bit bigger. But the thing that they have in common is I think they all hit above their weight class, and none of them really needed to be convinced that the world is changing and they need to be able to adapt. And so they are really quite collaborative on sharing ideas, sharing best practices, sharing things that didn't work. And being able to share those lessons learned is really quite valuable. And then over the years, we've added a venture capital fund, the Alloy Alchemist Fund, and then my role is leading the Alloy Labs Institute, which is where we are bringing best practices, tools, and frameworks to the leaders of those banks. And those 3 things together give us really a pretty broad ecosystem that we're finding insights that can apply to both sides of the equation. And when we're working with fintechs, we're not looking for those that are just replumbing banking. We're looking for those that are really reinventing and creating new sources of value.
I mean, you passionate, you you know this industry, you decided to go and focus on the next big innovation, not the incremental innovation, but the next big thing, what those fintechs will bring to the table and change for the better. But you must have frustrations. I can't believe that everything is perfect.
Oh, everything's not perfect. Yeah, it probably never will be. I'll tell you, we frame it in terms of what we call extend the line, bend the line, and transcend the line. Most of what we do all day long, every day, is just extending the line of our existing results, right? Very, very minor incremental changes. And that's okay, right? You have to extend and defend that core business that you've built over time. So I'm more than okay with incremental innovation. One of our member banks told us, slightly embarrassed, that they were really proud during the pandemic that they used 19th century technology as an innovation. They cut a mail slot into their door because customers had deposits to make and the bank wasn't open. So they created a mail slot. And we celebrated that, right? There was no massive technology investment, but it was the right thing to do because it solved a problem for customers. And the tools and the systems that we have developed for decades and centuries around this industry are really good at helping us extend the line. Where I get excited is helping to bend the line. What happens if that low to mid single digit growth isn't good enough? Well, then we need new tools and new systems and new processes. And every now and then, maybe we even get a chance to transcend the line. Now, that's not going to happen too often. What I'll tell you is our research has shown, and other external research has shown this as well, is that organizations that are successful in innovating have both top down and bottom up. The top down is important because they're setting the tone, they're giving permission to do something new, they're providing funding and governance. And the bottom up is really important because those are the people that are closest to the customers. Those are the people that understand the jobs to be done and the pains. Where the frustrations often comes is what's referred to as the frozen middle. In the middle, you don't really get a lot of rewards for doing something different. You don't really get any upside reward of doing something new. You're only going to get punished if it doesn't go well.
I want to take you, somewhere else completely. This show is called Money Travels. Which part of the world should we go next to find the next big thing? Or do you think like the very groundbreaking innovation is coming from?
Certainly in the developing world, we're seeing a lot of interesting things. Certainly look at China, where it's not about the banks, it's about commerce. It's about e-commerce that are driving the kind of changes, and the money movement, the payment really just facilitates that. And one of my favorite questions to people about taking a ride share is, well, tell me about the payment experience. And they usually have to stop and think about it a little bit. And I think the answer is there isn't a payment experience. I don't want a payment experience. I want a ride from point A to point B. And I think what we're seeing in a lot of the developing economies it's not about having payments, not about moving money. It's about acquiring something. It's about selling something. So that's been a phrase we've used for the last couple of years: embedded finance, embedded payments. It just starts to become more and more invisible. So I think it's less about look at what the banks are doing and look at what companies and countries are doing. Look at what people are doing. Money is really just the lubrication for all of that. And money has to flow to make things happen. And the easier that we can make that, the more contextual we can make that, the better.
It's the integration of the money movement within everything that we do, right? And how this is part of the experience, as you said earlier, rather than a specific moment in time. Rich likes to talk about moving money with purpose. We do it for a reason, and what matters is the reason. The rest is helping to serve that need, right? To deliver on that reason.
That's right. And I think, again, I'm fairly U.S.-centric in many of my comments because that's where I spend most of my time. I have traveled a fair amount of the world and worked with institutions of all sizes around the globe. But in the U.S. and again, most developing countries in different degrees. But we have this proliferation of small to mid-sized community banks, fairly unique here in the U.S., and many of them really aren't thinking holistically enough about money movement and payments. It's a cost center. It's a function. It's a sort of technology that we need to have. And I think when we think about context, when we think about purpose, when we think about edge of money, suddenly that transforms the entire conversation.
I mean, we could talk about this for forever. Maybe I want to end on one point, which is a question of, that's obviously a conversation topic in the consortium you have at Alloy and in the work you do in terms of the opportunity of moving towards the edge of money. Is there also a conversation around what happens if they don't, and what happens if they just stay in the center? I mean, the impact, you've said yourself, like you've gone from 13,000 banks in the US, 18 years ago to 4,500 or less than 4,500 now. So maybe if you could think about that in both the impact of the banks themselves, but probably more importantly, the impact to the end user, be it a small and medium-sized business or a consumer.
One of the difficult things for bankers to understand the reality is lack of innovation is never written on the tombstone of a bank. When banks fail, ironically, they fail at the things they're supposed to be good at, right? Managing liquidity risk, credit risk, interest rate risk, right? Those sorts of things. It's really not failure. It's consolidation. My partner, Jason Henriks, likes to talk about, why would I pay you a premium for a bunch of customers I don't want, technology I can't use, branch locations I don't need, or to put it even more bluntly, why would I pay you for, any of that? I'll just punch you in the mouth and take your lunch money, right? And we're seeing that, right? The brutal competition that's happening. So it is an existential crisis for the banks, but it's hard to understand because we don't get the big headlines, the blockbuster headlines, the Nokia headlines, the Kodak headlines, right? There's not a big bank that failed because they failed to innovate. But the reality is, that is one of the causes of death, is if you're not relevant to your customers, not sufficiently relevant to your customers. And then as far as that impacts the consumers and the small to mid-sized enterprises, well, they have less choice. They're now focused on trying to replace what they used to have. And in most cases, that's in the small oligarchy of banks, the big banks that are providing, pretty similar things at maybe not so good prices and not such a good impact on the local economy and the local decision making and so on. So being a community bank is a good thing, but you've got to be highly relevant to your customers.
One last question. We'd like to ask you, who are one or two people you would like to see on this show? And what would you kind of like to hear from them? Who do you want to hear from?
I don't pay enough attention to financial inclusion and making sure that people in all spectrums of the economy are being well served. And I think there are a couple of nonprofits, there's several actually, but two that come to mind, and I know them both, and I have talked with them both, but I think Costa Peric at the Gates Foundation here in Seattle, and I think Jen Tesher at the Financial Health Network in Chicago. They're both doing a lot of work at really understanding the emotional needs and motivations behind money and what it means to individuals that maybe don't have the choices, don't have the resources, don't have the capabilities. So I think my question is, how can we leverage these technologies and the advances in money movement to really improve financial inclusion around the globe? I think it's a fairly overlooked issue. There's talk about unbanked and underbanked and all of that, and there are kind of shadow financial services, but I think that there are too many of us being left behind, and I'd love to learn how we can fix that.
I love that question.
Great question.
Yeah.
So we'll send out the invite, as a courtesy of JP Nicols. JP, listen, it's been fantastic. Thank you so much for your time.
Really enjoyed the conversation. It was absolutely insightful.
Thank you. It's been my pleasure.
That's it from us this time. And of course, don't forget to follow us on Spotify, subscribe on YouTube.
And if you enjoyed what you heard today, leave us a review, tell your friends, or better still, do both. So we'll be back next episode to explore more life-changing innovations in digital finance. So wherever your travels take you, remember to join us for the next installment of Money Travels presented by Visa.